Hello, everyone. This is Chris Markowski, President of Markowski Investments and host of the Watchdog on Wall Street radio show, here to talk about buying stock on margin. Well, let's go back to the 1920s. You remember that big stock market crash they had around 1929? Well, one of the reasons, not the only reason, but one of the reasons that happened was the fact that many investors out there went out and jumped into the stock market head first. Woo! Stocks can't go down. No, how could that happen? And they bought stocks on margin, a lot of leverage. And at that point in time, all a lot of investors had to put up to go purchase a share of stock was 10%. So if you had a $100 stock, you go out and buy a $100 share of stock for $10. So obviously you can see what the problem is when things start going in the wrong direction and you start getting margin calls. Well, they changed the rules, and the Securities and Exchange Commission decided, and well, they actually put together the Securities and Exchange Commission, that you have to put 50% up when you go ahead and you buy a stock. Now, you put 50% up in that margin account and you bought $50 and you buy a $100 stock. What happens if the stock goes down? Well, you're going to get something called a margin call, meaning that you've got to send more money into that account to keep it up to the 50% margin that they require. Something to consider, people. You also pay interest on this money, and sometimes it can be pretty hefty, 7-8%. Margin should be only used over a very, very short-term basis on a trading event, and something that should be used by the professionals. But as we've learned over this past year, the professionals don't really know how to use leverage, do they? We're watching all these investment banks go under. Leverage is a very, very tricky thing, and I would try to avoid it. This is Chris Markowski, your watchdog on Wall Street.